Last night, my wife and myself were watching TV, and we were watching a show on Amazon, a very old one, about 8 years old or 7 years old. It's called Person of Interest. And it's about two big artificial intelligence robots that try to conquer the world. One is called Samaritan. It's a bad AI machine trying to manipulate police and crime. And the other one, a good one, the machine, who is trying to anticipate bad things and stop them. Now, that was about 7 or 8 years ago that people conceived of this almighty AI running the world. And I remember reading the book, The Fear Index by Robert Harris, a wonderfully written book about a machine in Geneva, a computer in Geneva, that can anticipate events that have not yet happened, simply by reading signals from all over the world and then anticipating there will be a terror attack this morning in about 2 hours' time, sell off all your stocks. Now, this was about 8, 10 years ago when we thought that these new super fast computers could do everything and anything and be almighty. I'm quite sure eventually we will get to this point. Professor Schmidhuber, who is one of our strategic partners, said at the conference, well, actually, once machine intelligence exceeds human intelligence, we will be pretty useless, because as humans, we are very deficient organisms, and the machine would be much more rational, and we would be just an obstacle for the machines to run the world. I'm quite sure we will get to this point, but it's still a long way off. The reason why I'm saying this is because last year I was pretty disappointed by the artificial intelligence run investment programs, and I would like to show what has happened in the meantime since I was so critical about our industry. The reason why I was so critical is that we heard about so many AI-powered funds that said read all the news sources. We have so much knowledge about what's happening in the world, we can predict almost anything. In fact, the whole Corona crisis, which was very prominent in all the news channels, wasn't anticipated by any of the machines. With this, I want to start into my presentation. It is not a very long one. I was deeply disappointed about a year ago. Corona was a really big data event and could have been easily modeled into any of these AI-powered investment algorithms. Just look at the news flow in China, very easy to integrate. Look at the temperature readings of people who measure the temperature, body temperature, very easy to see and measure. So all of the models failed in taking this into account. None of the models even remotely caught the sudden downturn in stock prices. That was last year. And my presentation today is about what has happened since. And this is my criticism. I read this from one of the previous presentations in our conference. I don't know, was it number 5 or number 6? I don't know. 2 million relevant articles, news, research, blog, and tweets, utilized daily 17 messages per second from 38 million authors, hundreds of millions of tweets daily. NLP algos extract the mood across securities, government, and politics, compressed into powerful sentiment signals, except these signals were completely ignored by the machine. So that was why I said, no, this is slightly too much hype for my taste. But we have made progress in the world of AI. If I just generalize about AI in general, I think on the consumer side, we see incremental progress, which you hardly see, but it makes things more easier and more reliable. I would call it going from 95% to 97%. I'd say to get the first 80% is relatively easy. My colleague Kevin Endler, who will speak after me, this is a couple of years ago. Now let the machine see the difference between a baby and a gorilla, and it will do this very easily if you give them 200 samples to compare. But then the tricky stuff starts. You want to go into the detail, and all of a sudden it gets very, very hard. We see the progress in voice recognition, in transcription, translation. I'm a heavy user of DeepL, which is a German-based translation service. I think the English that comes out of my German text is much better than my own English, and going both directions. I think it beats humans most of the time, but it's really, really hard work. And we see a lot of progress in image recognition, image rendering, and in avatars. I recently heard a presentation by a Chinese company, Chinese-American company, Pinscreen. You can basically design your own avatars, give them your voice, and it looks almost real. So I think in movies, movie direction, movie imaging, we made huge progress. And the moment you don't notice anymore, it has become very good. We have seen huge progress in biologics and chemistry last year. I remember reading about the NVIDIA simulation of the cell and the coronavirus, simulating, I think, 300 or 350 million molecules in one huge machine. I see huge progress in simulation of molecules for pharmaceutics. So there's a lot of things happening, and I believe the medical field will change a lot over the next 5 or 10 years. Will change dramatically, to be more precise. We have an abundance of papers and models, none of which are fundamentally new. I haven't seen any real breakthroughs in AI technology. And we have hardly seen any progress in autonomous driving, in finance, or in medical diagnosis. Autonomous driving, I mean, just go back 3 or 4 years, Tesla with the autonomous mode. It works most of the time, but it has to work 100% of the time. And this last step is a very hard step to take. Companies like Waymo or companies like GM are doing good work. You can see the statistics on the California Automotive Administration page, but it's still a few years away from being out in the real world for practical persons. Finance, I see stepwise progress, but not huge breakthroughs. And medical diagnosis, I'm still waiting for the imaging progress, the dramatic progress. It's moving very slowly. So what I would say that we are now in a hype winter. The Gartner hype curve, people talk a lot about things, everything is hype, the future is here already, and then you don't see anything for a couple of years. And I think we are now in a kind of a hype winter. Progress is moving forward, but you don't see much. Everybody is hiding, is doing their work, is doing their homework, making progress, but not visible and not apparent in the media. I find our players in the industry less colorful. I hope this is not an insult to the people presenting today. I think they are very respectable presenters today, not of the boastful type, very realistic, very considerate, very mindful product offerings that we will see today. So the hype is gone, reality is coming in. I find, despite Fred Sage's claim that the number of funds is increasing, I still find the volumes relatively small. A couple of years ago, we anticipated that it would become huge and very fast. It is not. It is still a niche product. Funds powered by AI are still relatively small. I think we have all lowered our ambitions. Although we call our internal model the world machine, well, we are realistic. It is not a world machine. We have many data, but we have a very limited focus on what we are doing. Our focus is to get a moderate outperformance, but we are not trying to beat anybody at any time. And the performance is becoming more reliable, which we will see in the charts that we see in the next couple of minutes. Let me look at last year. This chart starts January 1, 2020. The red line as a reference point is the MSCI World Index, and the upward sloping one is the MSCI World. The downward sloping one, the steady one, is the REX-P index, our German bond index. So I suspect that a good AI fund should be able to be in the upper range somewhere up here and beat the REXP handily. The first thing I did is I looked at our own funds, and they are colored blue. That's our company color. And I have 2 machine-run funds and 1 human-run fund. And what you can see clearly is the best fund and beating the MSCI World by a huge margin, the AI Buzz Index, which makes use of social media. Then after artificial intelligence, the next in line is human intelligence. That is the Datini Fund, a very free-ranging, liberal, all asset classes fund run by humans in our company. And here, down here, we find the AI fund, which is a numerical AI-driven fund, which after a slow period has started to outperform quite steadily over the last, I'd say 12 months. So I'd say not bad. AI-powered funds are on par with very good human funds and can beat the MSCI World Index by a margin. What about the rest of the industry? I had about, now how many, but maybe 20, 25 funds in last year's presentation. And this is the complete picture of the funds in that universe from last year. And you see the red line here, which is the MSCI World Index. There's quite a number of funds that have beaten the MSCI World Index in the last year. An acceptable number of funds that are somewhere in between the bond index fund and the MSCI World, respectable for balanced portfolios, and 2 or 3 underperforming funds where I'd say, well, AI didn't quite work as expected. So overall, I'd say the dreams are very big, but the performance is respectable. It is not overwhelming, but it is quite sound. Within our own funds, I try to find out, are the machines better than the humans? And this is the chart that I had on the previous page. The blue line represents the AI-powered funds. The red line represents the human-run funds in our own company. And what you can see in this month by month, January 21 to May 21, and it is the percentile of stocks, or the ranking percentile of the stocks picked in their relative subsector. Our AI tools are trained to find the best stocks in a given sector, the best steel company, the best liquefied gas company, the best biochemistry company. And if you are somewhere in the middle, the ranking would be 50 at this level. If you have 51, that means that 51% of the stocks are below you and 49% are better than you. And we all know that a performance of 53% correct decisions is already a pretty high percentage and is enough for a good outperformance. We see that the humans are doing better than the average market, so we are outperforming. But we also see that the AI-powered funds are outperforming the humans again. So we can see within our own company that on moderate objectives, AI is doing better than the humans. And now my personal aim is to get some of that knowledge from the machine into the human mind so we can learn from each other. This is the complete list, the final ranking of the funds that started last year, that we had in the portfolio since last year, in this reference portfolio that you saw on the chart side. What happened to the best performers from last year and who are the new winners this year? What happened to the last year's top 5? Let's start with, and this is the sequence that we had last year. The AI Buzz US Equities, which was developed jointly with Periscope Capital in Canada, works on artificial intelligence, on artificial interpretation of tweets in the United States, social media, news portals, blogs, etc. It kept its top position at 79.5% 79.5% performance since January 1, 2020. We have the Merlin AI Tactical Growth and Income Fund. It is still good with a plus of 14.5%, so somewhere in between bonds and stocks. But the scope is limited. It says the index methodologies are not solely based on AI, but it is a supporting tool to identify bull or bear market conditions. We have the Art AI Equity using alternative data. So this is not so much about AI in the interpretation of data, but it's more in the quality of the data sources that are being used. It lost 0.5 percentage point over the whole period. With the Genio Primo systematic macro program trading, it uses it tries to predict investor behavior using AI tools, and it's somewhere in the middle between equities and bonds again, so respectable, but not overwhelming. And we have the Tungsten Tricon AI Global Market Funds, also middling between equities and bonds at 8.9%, using artificial intelligence to identify trading opportunities in financial markets. So it's a mix between alternative data, AI as a supporting tool, and AI as the sole tool for running the fund. Who is behind this year's top 5 funds? We still have the Buzz Fund on top of things. Not surprising, since all these Reddit posts were a rich source of information. You remember the GameStop and the AMC hype, a wonderful source to be exploited. This will probably level off over time, but for that past time period, it was wonderful. Then we have the EcoBot AI-powered equity ETF. It claims to use IBM Watson model for machine learning, sentiment, and natural language processing. And this is in the number 2 position since last year. It uses 4 submodels: a financial, a news, a management, and a macro model. And like most good AI programs, it uses ensembles of models to get a final output. Then we have the Société Générale US Machine Learning Long Equity Index and Fund. SocGen doesn't really disclose what they are doing. They say it's machine learning. We don't know the details. With the Amundi on position number 4, Amundi Stocks Global Artificial Intelligence, it uses knowledge graph technology, and the key data source is the identification of patent filings. So it's about intellectual property, seemingly as the major source of information for this fund. And we have the Merlin AI Bull Rider Bear Fighter. This fund uses multiple AI tools to identify leaders in bull and bear phases, and taking 2 ETFs from sector bonds and factors. I think 8 in bull markets, 4 in bear markets, and it tries to switch between bull and bear. Now let me look at what leading scientists are saying about what we are doing here. This was a conference of Nobel laureate meetings happening last week. And we had people like Vinton Cerf, one of the, I'd say, inventors of the internet. And we had Bernard Schölkopf, whom we all know as one of the inventors of the support vector machines, together with other participants, talking about AI in natural sciences. And I took some of the claims that they were making. Vinton Cerf said, we rely excessively on models without knowing what they are doing. It's just stuff in, stuff out, garbage in, garbage out. And he said we should look for causalities, not correlations. And the two jointly said, machine learning actually requires stable populations, stable distributions, and stable sampling. And they also said the machine is also learning from us. Our input into Alexa is a learning input, so it's quite interactive. Let me go into these 4 claims. We rely excessively on models without knowing what they are doing. I believe that the time of put everything into a big machine and let artificial intelligence find any output, it seems to be over. There is no world machine where you just dump everything and try to find a magic solution to all the world's problems. So this quote from last year, 2 million relevant news, etc., would no longer be considered serious. It seems that today's models are less ambitious and more focused than in the past. They try to understand the data. They are more limited in the usage of the data and more limited in what they try to predict. We have to look for causalities, not correlations. Well, that's a natural scientist saying this. I believe in the stock market world, this is not as important. First of all, these causalities disappear in a reflexive world. Usually in the beginning of stock market valuation in Benjamin Graham's times, we would have said a higher stock price results from a high income, high profitability, high value. This is changed or morphed into increasing income. The data that we utilize, if we have a confirmation of the same income, the market doesn't do anything. If income is increasing, only then the stock price moves up. And this is morphed into, we expect an increasing income. We are trading expectations of a change in income. So kind of a second derivative. And then we go further and we say we don't want the expectation of the income only. We want to compare the best and the average estimate and make a profit out of the best estimates of the expectation of an increased income. And then finally, we end up at the relative expected development of the income relative to the expected income expectations in the industry. So we're moving into second, third, fourth derivatives of the original. And we are far away from causalities. We are looking at very modest patterns in derivatives. And in financial markets, all recognized causalities disappear through arbitrage. That's what we saw on the last page. And we don't actually need causalities. We need reliable but time-lagged correlations. If there is a correlation over 1, 2, or 3 months, we can exploit it. If it makes sense or not, if the correlation is stable, we are happy. We don't need to find the real reason behind it. It can be an unknown third that explains both effects that we see. We are hunting for new unused data from the real world to supplement financial data. New data sources coming up every day. We try to look at previously unused correlations that are not well known, drawn from a different angle, a different look at the data. And we are now using machines because real correlations are frequently too complex to be identified by humans. The machines can see connections that we as humans don't see, especially if we move across away from bivariable correlations into multivariable correlations. Machine learning requires stable populations, stable distributions, stable sampling. This is absolutely violated in machine learning in financial markets. Nothing is stable in financial markets. The rules of the game keep changing. The political and monetary interference keeps changing all the time. Data distributions are not stable at all. Markets are reflective. They adapt to our actions. All of these make it a very difficult field to exploit through AI. Also, data definitions and usage vary over time. Just look at fields like comprehensive equity or the use of the valuation of unrealized unrealized gains in the balance sheet. It keeps changing all the time, and it is not stable, very difficult to exploit. And sampling is heavily influenced by hindsight. Since we know what has happened, we try to interpret backward. Our mind is not fresh. We are biased when we apply our computer models. If I look at the outperformance of AI-powered funds, this is an analysis from Plexus Investment in Switzerland. It is not stable, currently underwhelming. Many AI-powered funds are not doing well. They're doing positive, but not outperforming. And I have to say that what Fred Say showed, this is the chart on the left graph, the new index, compared to a completely passive portfolio. This is an index on selective that we designed 5 years ago. We didn't touch it ever since. This model has to prove itself by selecting very good AI-powered funds, and it has to beat a passive index. So the proof is out. I'm very curious to see how the new fund will develop. My recommendation for everybody is define a problem in a very narrow way and try to solve it. Don't try to solve all the problems of the world with one huge model. Find good input data, try to understand the data, look closely at what is happening. I think only from the detail you can learn what the data really mean. Learn from a few examples like a child. We all know that big data consumes an excessive amount of examples. I believe sometimes 3 or 5 examples should be predictive. And we have to do more along the lines of one-shot learning. And in the end, you will find that most likely the model is not the most important component. Once you know what the input is, once you know what you want to look out for, the model becomes secondary to your thinking. It helps solve the problem, but it's not the most crucial part. And with this, I want to conclude. Tell everybody that the world is a difficult place and everything can go wrong. And I'm ready for questions.